Joining me now is Harvey Flax. He's the Director of U.S. Interest Rates Futures Business Development for Intercontinental Exchange. Harvey, welcome to the show.
Good morning, Ashley. Thanks for having me on.
So what are futures indicating right now about today's Fed meeting?
Sure. Let's jump right in. The futures market is indicating a near 100% probability that the Federal Reserve will lower its monetary policy rate, Fed funds, by 25 basis points this afternoon, moving their target range from 4.25 to 4.5 to 4 to 4.25%.
All right. And what are the market views on shorter-term Fed policy?
So in addition to today's pricing, the market's also pricing in roughly an 85% probability that the Fed will have a second 25 basis point rate cut at its next meeting in October, and a 75% probability of a third 25 basis point rate cut at its final meeting of the year in December.
All right, and recent public statements from a few of the Fed's policymakers are reflecting a change in sentiment on interest rate policy for the rest of the year. What are the drivers behind this?
Sure. Certainly a sentiment change at the Fed since the last meeting in July. And interesting, that last meeting in July had a unique event for Fed meetings. For the first time in about 30 years, you had two board members vote against the majority. They dissented. They voted for rate cuts, where the remaining 5 board members and 5 bank presidents voted to keep rates on hold. Now, looking at this afternoon's policy meeting, it is quite possible that you will have a similar, though maybe not as historical, where you could have the majority voting for a 25 basis point rate cut. You may have 1 or 2 policy makers voting for a greater rate cut by dissenting. And you could also have 1 or 2 policymakers dissenting to keep rates on hold. We'll find out at 2 p.m. Now, to answer your question about the driver, simply deteriorating labor market conditions. Since the July meeting, up to the July meeting, I should say, the Fed indicated that they had the luxury of waiting to lower interest rates this year as they focused on stubborn inflation with the background of a steady state labor market. Since the July meeting, the last 2 labor reports have indicated deteriorating conditions in that labor market. Basically, they have come in below forecast. And more importantly, the last 2 reports have reflected a significant downward revision of those reports, those data reports.
And the summary of economic projections will be released today. Can you talk a little bit more about that and how it might indicate what the market thinks is going to happen?
Sure. Now, the market itself is basically pricing in 3 additional 25 basis point rate cuts for next year. 1 in March, 1 roughly mid-year, either at the June or July meeting, and 1 at the end of the year, either the October or November meeting. Now, the summary of economic projections, also known as the dot plot, economists believe that the Fed will be somewhat, or the Fed at all will be somewhat more conservative, perhaps pricing in 1 or 2 25 basis point rate cuts for the end of this year, and perhaps 1 or 2 for next year. Again, they're going to be completely focused on keeping the country fully employed, but at the same time managing inflation.
And Powell will be making remarks after this meeting. What are your expectations?
Well, not so much mine, but the economists believe that with a 25 basis point rate cut, he will have to address the why, the driver for that 25 basis point rate cut. And obviously, more than likely, it will be those deteriorating labor market conditions. They also believe that Chair Powell will continue to reflect that the Fed will remain data dependent, that every meeting is a live meeting, and there could be an adjustment to monetary policy, and that their focus will be to continue to keep inflation near their 2% target range, as well as maximizing employment in the United States.
All right, and this Fed monetary policy, what are the implications on the mortgage rates and housing market?
Well, the mortgage market, specifically the 30-year fixed in the United States, which is roughly 85% of the mortgage lending, is driven by the U.S. Treasury yield curve, specific to the 30-year, the 7 to 10-year sector. Now, the Fed drives the shortest term interest rates in the country, basically governs short-term loans. In general, there's little crossover, but in a rapidly declining rate environment or rising rate environment, you could have some crossover, and it could impact the Treasury yield curve. With that said, the ICE 30-year fixed mortgage rate lock future is indicating that 30-year fixed mortgage rates will be approximately 6% in March of next year.
All right, Harvey Flax from Intercontinental Exchange, thank you so much for joining us this morning.
It's a pleasure to be here, Ashley. Thank you.
you.